Why traders should spend more time studying where trends or environments may change than looking for targets. And we'll go to the charts to look at Ethereum and Nasdaq. Let me take you to this week's NinjaTrader Charting Edge. Pulled up Ethereum here on the daily, same old, 20 period, 3 standard deviation Bollinger Bands. Red is the 10-day simple moving average. I talk a lot about ETH. This has been, for the past year and a half now, my biggest position. And one of the things I look at when I start to take some ETH off the table is exactly what we're seeing now. So recently I took some ETH off the table, and it's because of what we see right here. It's a repeated pattern that I've seen many times before in ETH and in a lot of markets that I follow. We get this grind higher, Bollinger Bands come in, they start to open up, we go to the previous peak on the daily, start to come back off, get back below the 10-day moving average, and you've seen this type of pattern. That's when that recent kind of high was set in and we chopped down to, what was it, maybe around 2,600, grinded back up, Bollinger Bands opened up again. Choppy Bollinger Bands, you know I don't love that, but went back to this old peak high of the Bollinger Bands off of this high. So it's that repeated cycle, right? We have this peak of the Bollinger Band right there. Market comes back down, grinds up, hits that peak, gets back below the 10-day, grinds, eventually opens up Bollinger Band again to that peak high, comes back off, gets back below the 10-day, choppy for a period of time, gets back above the 10-day moving average, hits that previous peak. So what we could be seeing here now is very similar to what we've seen here and what we've seen back there. So for me, as a long-term holder of ETH, I like to use those areas as targets. And when we get back below the 10-day moving average, which we just got back below, tells me that we are now starting to see some weakness, possible change of environment, at least for the short term. So you trim some ETH. I think in the near term, what we're going to watch for is, will this Bollinger Band continue to open up? We regain the 10-day moving average, grind higher. That could possibly happen, maybe reestablish more longs again. But if that Bollinger Band starts to come back in and makes a peak similar to what it's done there and there, then I think we're going to be looking at sideways to lower in ETH. That's this week's NinjaTrader Charting Edge. In my intro, I talked about how traders should spend more time studying where trends or environments may change than looking for targets. I put this tweet out the other day. I focused most of my chart time finding areas where I think trends and environments can change, not where I think a market can go. If you know where a trend or environment will change, you can find a way to participate in the current trend. Where a market may go is far less useful. And Ripto Coin put in the comments, that's awful wordy, maybe some examples will help. He asked, I'll answer. Let's go to the charts. So for the example, I wanted to pull up the E-mini Nasdaq 100 futures chart on a daily. Same indicators as I use each and every week in the NinjaTrader Charting Edge. 20 period, 3 standard deviation Bollinger Bands. Red is the 10-day simple moving average. Now, first let's talk about targets, right? Because that's what everybody always seems to look for. And my targets I use for every market that I trade are the peaks of the Bollinger Bands. That's where I think a market has potential to go. So as you can see here in the Nasdaq, it's 16,200. But what did I say in my intro? I want to know where the trend or the environment may change. That's more important to me. A target is much less useful. Why? Because if I think we're going to go to 16,200, we may go there. I don't know. That's a target that I have. I really need to know what. What do I say all the time? Know where you're getting out before you're getting in. Second trade first. And how I understand where I'm wrong is, where do I think the trend will change? Where do I think the environment will change? So I'll go to the charts and I'll look and I'll say, okay, well, right now we're holding above the 10 and 20-day moving averages. This is why I like moving averages. Because you could see in the short term, we're holding above those moving averages, telling me that the short-term trend is pretty powerful. I talk about this a lot. The simple 10-day moving average, not an entry area, but a gauge of trend. So I know the trend is to the upside, holding well above the 10-day and the 20-day moving averages. Where I think it will change is if we get below them. See, right now the mouth of the Bollinger Band is open on a daily. So what that always indicates to me is two things. One is if we stay above the 10 and 20-day moving averages with the mouth open, we're going to go and hit those peaks. If we fail to hold them with a mouth open, we could rip all the way down and hit these previous peaks down here. So when a mouth of the Bollinger Band is open, it tells me we could be very volatile. So the 10 and 20-day moving averages are going to be my guide for direction. We're above them, we can go up and hit the previous peaks, which is 16,200. If we get below them, the environment and the trend changes, and we could go down and get these peaks down below at 14,000-ish area. So why is this so much more important to me than the target? Because I now know when I go to look at my 60-minute and 30-minute charts, because that's what I use for my swing trades, my range of execution is going to be holding above the 20 and 10-day moving averages, and I'll look for confirmation on the 60-minute and the 30 minutes to help me get into the market. Let's go to a 60-minute Nasdaq. Here we are at a 60-minute Nasdaq chart, and what I find interesting is that when you looked at the 10 and 20-day moving averages, the lowest one was the 20-day, which was roughly 600 points lower than where we are right now. And the target, like I said, was going to be around 16,200 in daily. That's a bigger picture target. So what I'll look for is, okay, we're holding above the 10 and 20-day moving averages. Mouth of the Bollinger Band is open. That's a green light for me to be long. The trend is powerful to the upside. As long as we hold above them, the trend will remain intact. The environment will remain bullish. So I look at my 60-minute charts and say, okay, do we see a similar pattern happening? Mouth of the Bollinger Bands is open, just like the daily, holding above the 10 and 20 simple moving averages. Those aren't daily moving averages. Those are just simple moving averages on this period, which is 60-minute. So I look at it and say, okay, I can now buy in this range and maybe use the 10 and 20 period moving averages on the 60 as a way to guide my trade and my swing position. Because if we hold above these, I'm seeing that same action on a daily. And I'll even use these shorter term 60-minute peaks of the Bollinger Bands as targets along the way up. So if we start to establish above the 10 and 20 simple moving averages here in the 60-minute, look at these previous peaks as targets. You got roughly 15,680-ish, and then here's roughly around 15,800. So it'll help me work my way in and out of the position. So I'm looking for a similar environment on the 60-minute to help guide me to trade what I think my bigger picture is on the daily. Let's take it down even to a 30-minute. So what I'm looking for is layered confirmation. Daily we know is bullish. Mouth of the Bollinger Bands are open above the 10 and 20-day simple moving averages. Think we could be pretty volatile, and 16,200 is my target. But more importantly, where does that trend change? And that trend changes if we get below the 10 and 20-day moving averages. Really the 20-day, because that's about 600 points lower. I really think the trend changes there. So I look at that and say, okay, I've got some room. What are the 60-minute and 30-minute charts looking like? 60-minute looked almost just like the daily. So I could use those 10 and 20 simple moving averages as a guide to hold a swing position. And when I look at the 30-minute, also very similar. Mouth of the Bollinger Bands are open. 10 and 20 simple period moving averages are holding above them as well. I could use those little dips down into those areas as longs. Now, my stop is going to be, actually, let's go back to the daily. I wanted to come back to the daily to tie this all together and show you where my stops are going to be, because remember what I said, what's more important to me? Where the trend or the environment changes, not my target. I know that 16,200 is a big picture potential target. That doesn't mean that we're going to get there. I just think that we could possibly get there. That matters to me, but not nearly as much as where I'm wrong. So because I know that I'm wrong, if the environment or trend changes below the 20-day moving average, all of my stops have to be below there. So if I'm using 60-minute and 30-minute charts to help me execute my swing positions for entries, as long as I'm getting in above these areas, I'm able to put my stop in down below here. So I'll use the daily as the gauge once again for the environment, pull it back to 60 minutes, 30 minutes, see if they look the same. If they do, I'll use simple moving averages or other ways to get in. But as long as my stops can be, this is for swing trades now, below the 20-day moving average with the upside potential of 16,200. But like I showed you on the 60 and the 30 minutes, I'll use those Bollinger Band peaks as areas to take off some risk. And then I'll continue to work my way in and out of a position. I call it trading around a core position. And I'll keep looking for longs using the 60 and 30-minute charts as guides. But as long as my stops are well below the 20-day moving average, because that's where I think the trend or the environment will change. Remember, traders, micro treasury yield futures are now live. Pull up 2YY, 5YY, 10Y, and 30Y. to see what micro treasury yield futures are doing. And to learn more, go to cmegroup.com. Final thoughts for today. Remember, traders, if you focus on where a trend or an environment will change, that gives you that range of execution. You hear everybody always talking about managing your risk. Well, you manage your risk off of where you're wrong. All you're trying to do is decrease the amount of risk once the initial risk is established, and the upside potential is what it is. It's important to have targets. It's important to know what the market may do, but it's far less important than knowing where you're wrong. I put this tweet out the other day. If a winning strategy was all you needed to be a successful trader, then everyone would make money. Why doesn't that work? It doesn't work because strategies don't make money, traders do. There's a fine line between successful and unsuccessful traders, and one key difference is instincts. Recently, I did a podcast on Futures Radio Show about the 9 essential instincts that I have found are absolutely necessary in becoming a successful trader. And one of those things is execute off of the risk price. The targets don't matter to me nearly as much. So to get more out of today's video, I recommend you go and check out that podcast I did, the 9 essential instincts versus trading rules. Because like I say in that podcast, it's about having trading rules for your strategy, but instincts for your trading. And like I said, you're really gonna enjoy that one part where I talk about trade according to risk. Traders, if you enjoyed today's episode of Develop Your Edge, give us a thumbs up and hit that like button. If you didn't, give us a thumbs down and tell us why in the comments down below. Never miss an episode of Develop Your Edge. Hit that subscribe button. You could also DM me your questions or comments on Twitter at Anthony Crudele. Don't forget to check out Instagram, Anthony C. Crudele. That's right for today. See you next week.